Meet two friends, Alex and Ben. They grew up together, went to the same college, and landed jobs at the same company with the same starting salary. Their financial lives were pretty much identical. One day, over coffee, they made a pact. They'd each start investing the exact same amount, 300 every single month. No excuses. It was a simple plan to build a solid future. But let's fast forward 33 years to their retirement party. On the outside, they both look successful. They both built a nest egg, but when you dig a little deeper, the difference is shocking. Alex is sitting on a portfolio worth over $1.1 million. Ben has a respectable but way smaller $520,000. That's a gap of more than $580,000. How is this even possible? They started with the same money. They invested for the same amount of time. This wasn't about some lucky stock pick or a crazy gamble that paid off. This is the story of how a simple, almost secret investing framework created a massive wealth gap over time. It's a framework that's all about discipline over genius and process over trying to predict the future. And today, I'm going to explain exactly how it works. How one friend built a fortune while the other just built a savings account, and how you can use this exact method to make sure you're on the right side of that gap. This is the 7531 rule explained. 1. The illusion of sameness. The story of Alex and Ben is so powerful because it starts on a level playing field. We all know people like them, two friends who seem to be on the exact same path. For the first few years, their investments looked identical. They picked similar funds, and every month that $300 left their bank accounts and went into the market. After a year, their balances were nearly the same. After 3 years, still neck and neck. After 5, you couldn't slide a credit card between their portfolio values. Ben felt pretty good about himself. He was an investor. He was doing the right thing, putting in his $300 every month just like he promised. He thought he and Alex were running the same race at the same speed. He was wrong. He was falling for the illusion of sameness. This illusion is one of the biggest traps in personal finance. Just because two people are doing what looks like the same thing, investing $300 a month, it doesn't mean they'll get the same result. Ben was focused on the starting line. Alex was focused on the entire race. Ben saw investing as just a task to check off each month. Alex saw it as a dynamic system he had to manage with discipline. While Ben was just putting money in, Alex was following a set of rules. A framework that would, over decades, turn his identical contributions into a profoundly different outcome. He wasn't smarter. He didn't have inside information. He just had a better rulebook. And that rulebook is the 7531 rule. It's not a magic formula, but it's a framework that turns small, consistent actions into extraordinary wealth. Let's break it down and see exactly how Alex built his $580,000 advantage. 2. The unbreakable commitment to time. First up, and maybe the most important number in the rule, is 7. This is your commitment to stay invested for a minimum of 7 years. Not 1, not 3, not 5, 7. Why 7? Because 7 years is roughly the point where the magic of compounding really starts to overpower the chaos of market volatility. Think of it like rolling a giant snowball down a very, very long hill. The first few rolls are slow and kind of pathetic. You add a little snow, your $300 monthly contribution, and the ball gets a tiny bit bigger. For the first few years, you might even wonder if it's worth the effort. This is where most people get discouraged and quit, but Alex understood this. He knew that real wealth isn't built in the first few years, it's built in the decades that come after. The 7-year rule is backed by data. First, there's the famous rule of 72, a quick way to estimate how long it takes for an investment to double. You just divide 72 by your expected annual return. At a 10% average annual return, your money doubles about every 7.2 years. Committing to 7 years means you're giving your money at least one full cycle to double on its own, just from the power of compounding. Second, history shows us that while the stock market is a total roller coaster in the short term, its long-term trend is relentlessly up. If you only invest for 1 year, your chance of a positive return is basically a coin flip. But when you stretch your time frame to 7 years or more, the probability of having a positive return goes up dramatically. In fact, for major indexes like the S&P 500, finding a 7-year period that ended in the red is incredibly rare. This is where Ben made his first huge mistake. A couple of years in, the market had a bad year. It dropped 15%. Ben saw his hard-earned money shrink and he got scared. He didn't sell, but he did pause his contributions for 6 months, thinking he'd just wait for things to calm down. He broke the 7-year commitment. Alex, on the other hand, saw the dip as a discount. He saw it as a sale. He kept investing his $300, buying more shares at a lower price. He trusted the 7-year rule. Successful investing isn't about timing the market, it's about time in the market. The 7-year rule is a contract you make with yourself. You promise to ignore the noise, the scary headlines, and the fear, and just let your money do its thing for at least 7 years. This is the foundation. It's the patience you need to let your snowball roll long enough to become an avalanche. 3. The 5. Building an unsinkable financial arc. Alright, next up is the 5. This stands for diversifying your investments across at least 5 different categories. If the 7-year rule is the engine of your wealth-building ship, diversification is the hull that makes it unsinkable. The old saying, "Don't put all your eggs in one basket," is probably the most timeless financial advice there is. Ben heard this advice. He didn't put all his money in one stock. Instead, he bought a popular tech-focused fund, and for the first few years it was crushing it. He even got a little cocky, telling Alex that his old-school diversification was holding him back. Alex, however, was following the rule of 5. He was building an ark designed to ride out any storm. These 5 categories are meant to balance each other out so that no matter what the economy is doing, some part of your portfolio is likely doing okay. Here's a simple breakdown. 1. Large cap stocks. These are the giants, the stable, blue-chip companies you know and trust. They provide stability and steady if slower growth. 2. Value stocks. Think of these as hidden gems. They're solid companies that are just out of fashion for some reason, so the market has undervalued them. They have the potential for big growth when the market finally sees their true worth. 3. Growth at a reasonable price. GARP stocks. This is a hybrid. You're looking for growth companies, but you're not willing to pay a crazy price for them. It's growth with a seatbelt. 4. Mid and small cap stocks. These are smaller, faster-moving companies with the potential for explosive growth. They're riskier, but they can be the rocket fuel for your portfolio. 5. Global or international stocks. Investing only in your home country is a huge, unforced error. Global stocks give you geographic diversification, protecting you from a downturn in any one country's economy. Then the storm hit. The tech bubble that had been puffing up Ben's portfolio finally popped. His single-focus fund plunged over 40%. He panicked and sold a big chunk at a massive loss, telling himself he'd get back in when things were safer. So what happened to Alex's portfolio? Of course, his tech stocks went down too, but his value stocks, which had been kind of boring, suddenly started performing well as investors looked for safety. His international stocks were in a different economic cycle and held steady. The hit to his overall portfolio was much smaller, maybe 10–15%. He didn't panic. He didn't have to. His ARK was doing exactly what it was built to do: stay afloat. Diversification isn't about hitting home runs, it's about not striking out. It smooths out the ride, which is the key to staying invested long enough to win. By spreading your risk across these 5 categories, you build a portfolio that's tough enough to survive the storms that you know are coming. 4. The 3. The emotional gauntlet every investor must run. This brings us to the number 3. This represents the 3 major emotional battles that every single investor has to face. Investing is just as much about psychology as it is about math. If you can't get your own emotions under control, you'll never build lasting wealth. Alex got this. Ben didn't. These 3 emotional phases are totally predictable. Knowing them in advance is like having a map through a dangerous jungle. Phase 1. The disappointment phase. This is when your returns are just okay, maybe in the 7–10% range. You've been investing for a few years, but your balance isn't exploding like you dreamed it would. You see friends buying a new car or going on a fancy vacation and you think, what do I have to show for all this sacrifice? Just a number on a screen. This is the test of patience. Ben felt this hard. He started thinking his $300 a month could be better spent enjoying life right now. Alex felt it too, but he recognized it as a temporary test. He stuck to the plan. Phase 2. The irritation phase. This is when your returns are flat or barely positive, somewhere between 0% and 7%. You might even be earning less than a savings account. That little voice in your head starts whispering, why am I taking all this risk for nothing? I could be getting a guaranteed return in a CD. This is a test of your faith in the long term. Ben fell for this one. During a flat year, he diverted his $300 a month into a savings account for a while, thinking it was a smarter, safer move. Alex again did nothing. He knew markets move in cycles and that flat periods often come before strong growth. He just kept buying. Phase 3. The panic phase. This is the big one. This is when the market crashes and your portfolio is deep in the red. It's not a question of if this will happen, but when. Your hard-earned money saved for years seems to be evaporating. The fear is real. It feels like your house is on fire and every instinct screams, get out. This is where fortunes are lost. Ben, having been burned before, couldn't take it a second time during the 2008 financial crisis. He sold everything, moving to cash and locking in devastating losses. He told himself he'd get back in when the market recovered. He never really did. He missed the incredible rebound because trying to time the market is a fool's game. Alex felt the fear too, you can't not feel it, but he was armed with the 7531 rule. He knew this was the final boss battle. He had built his diversified arc for this exact moment. He had committed to a minimum of 7 years. He understood that panic was a phase, not a permanent reality. So he held on tight and just kept investing his $300 month after month. Winning these 3 emotional battles is non-negotiable. It means trusting the process more than you trust your feelings. Alex's ability to stay disciplined through disappointment, irritation, and panic is a massive reason why his portfolio started to pull so far ahead of Ben's. 5. The secret engine of the $580,000 gap. We've covered time, diversification, and emotion. That's all defense, the stuff that protects you from making dumb mistakes. But this last number, 1, is the offense. It's the secret engine that actively creates that massive wealth gap, and it stands for 1 annual increase in your contribution. This is, without a doubt, the most powerful part of the entire framework, and almost everyone overlooks it. Both Alex and Ben started by investing $300 a month, but Ben kept investing just $300 a month every month for 33 years. Alex, following the rule of 1, increased his contribution by a small, manageable amount every single year. He gave his investment account a 5% raise. Let's do the math. In year 2, while Ben was still putting in $300, Alex was investing $315 a month. That's just $15 extra. It's a pizza. It's a couple of lattes. It feels like nothing. In year 3, he bumped it another 5% to about $330. Again, a tiny change you'd barely even notice. But this tiny change has an earth-shattering impact over the long run. Why? Because you're not just adding more money, you're giving that new money decades to grow and compound on top of a bigger and bigger base. It's like pouring gasoline on the fire of compound interest. Let's look at the numbers behind that $580,000 gap. Ben invested a flat $300 per month for 33 years. Assuming a 10% average annual return, his portfolio grew to about $520,000. That's awesome. His total contribution was about $119,000. The rest was all growth. Now look at Alex. He started at $300 a month but increased it by 5% every year. At that same 10% return after 33 years, his portfolio grew to over $1.1 million. The difference is a staggering $580,000. Where did that huge gap come from? It came from that tiny, seemingly insignificant annual increase. The extra money Alex put in during the early years had 30-plus years to compound. That little $15 a month bump in year 2 was a seed that grew into a giant tree. Ben just kept planting the same small seed every year. Alex's seeds got bigger every year, and the forest he grew was exponentially larger. This step-up strategy is the key to turning a good plan into a great one. It aligns your savings with your career, since most of us get small raises over time. It automates saving more so you don't have to think about it. And most importantly, it weaponizes compounding in a way that flat contributions just can't. That single act of bumping up your investment each year was the main driver of the $500,000 gap between 2 friends who started at the exact same place. If this is starting to click, and you're seeing how these small, disciplined steps can lead to a huge change in your financial future, do me a huge favor and hit that like button. It tells YouTube this is good info and helps get it out to more people who need to hear it. And if you want more strategies to get ahead with your money, make sure you're subscribed. 6. The Great Divergence, a tale of 2 timelines. Let's put it all together and watch the replay of Alex and Ben's 33-year journey. Seeing this divergence happen is key to understanding the power of the 7531 rule. Years 1-5, the illusion persists. In the early years, you can barely tell their portfolios apart. Ben might even be slightly ahead if his tech fund is hot. They both cross the $20,000 mark around the same time. The gap is tiny. Ben is feeling confident. He's an investor just like Alex. Year 6-10, the first cracks appear. This is where the first market downturn hits and Ben makes his first mistakes. He pauses his contributions, violating Rule 7 because of irritation and fear, violating Rule 3. Alex, sticking to the rules, keeps investing and starts his annual 5% increase, activating Rule 1. By the end of year 10, a real gap has opened up. It's not life-changing yet, maybe $15,000 to $20,000, but it's there. The divergence has begun. Years 11-20, the curve bends. This is the decade where compounding really kicks in for Alex. His consistent, ever-increasing contributions are now being applied to a much larger base. His portfolio's growth is no longer a straight line. It's starting to curve upwards, becoming exponential. Ben's portfolio, held back by stops and starts and flat contributions, is growing more like a straight line. He probably faces another market scare and makes another emotional mistake. By year 20, Alex is way ahead, maybe by $150,000 or more. The gap is now big enough to buy a nice car. Years 21-33, the explosion. This is the final, jaw-dropping phase. The power of compounding on Alex's bigger, consistently funded portfolio goes into hyperdrive. The growth in a single year for Alex is now more than what Ben contributes in several years. His balance just explodes. Ben is still making money, but he's on the slow train while Alex is in a rocket ship. When they both cross the finish line, the results are in. Ben turned his $119,000 in contributions into a respectable $520,000. He did well, but Alex turned his disciplined contributions into a massive $1.1 million. The $580,000 gap wasn't created in the last few years. It was seeded in year 2 with a tiny $15 increase. It was protected during the first downturn by diversification, and it was locked in by the unbreakable commitment to stay the course no matter what. Ben's journey was defined by emotion. Alex's was defined by process. 7. How you can become Alex, a practical blueprint. This story isn't just a warning, it's a blueprint. The best part of the 7-5-3-1 rule is that anyone can use it. You don't need a finance degree or a huge income. You just need a plan and the discipline to follow it. Here's your step-by-step guide to becoming Alex. Step 1. Automate everything. First thing, make this as easy on yourself as possible. Open an account with a low-cost brokerage. Then set up an automatic transfer of $300 or whatever you can start with from your bank to your investment account every single month. Set it and forget it. Automation is your best defense against making emotional mistakes. Step 2. Build your 5-category arc. Don't try to be a stock-picking genius. The easiest way to get diversified is with low-cost exchange-traded funds, ETFs, or index funds. You can build a globally diversified portfolio with just 5 funds that track the categories we talked about. For example, an S&P 500 ETF, a value ETF, a small-cap ETF, and an international ETF. Boom, you're instantly diversified across thousands of companies. Step 3. Activate the 1 turn on auto increase. This is the secret weapon. When you set up your automatic investment, look for a feature called auto increase or annual increase. It might be hidden in the settings, but find it, turn it on. Set it to increase your monthly contribution by 5% or 10% every year. This one click could literally be worth hundreds of thousands of dollars to you. Step 4. Make the 7-year mental commitment. This last step is all in your head. Write it down if you need to. I will not touch this money or stop my contributions for at least 7 years. I will ignore the news, I will ignore my panicking friends, and I will trust the process. Remember the 3 emotional phases: disappointment, irritation, and panic, and see them for what they are: temporary tests, not signals to sell. That's it. 4 steps. By doing this, you create a system where building wealth is the default setting. You've taken your own flawed human emotions out of the equation and put your financial future on a path defined by discipline and the unstoppable power of compounding. The choice is yours. At the start of this story, Alex and Ben were the same. Same resources, same goals, and they made what looked like the same choice, but their results couldn't have been more different. That $580,000 gap wasn't created by luck or genius. It was the predictable result of 2 different mindsets. Ben's mindset was about action. I am investing $300. Alex's was about process. I am following the 7-5-3-1 rule. This rule is about playing the long game. It's about understanding that wealth is built not by making brilliant moves, but by consistently avoiding stupid ones. It's about having the patience to stay invested for at least 7 years, the wisdom to diversify across 5 asset classes, the fortitude to overcome 3 emotional hurdles, and the discipline to make that 1 annual increase. The most important thing to take away from this is that the small decisions you make today will define your financial reality in 30 years. The choice to add just a few extra dollars each year, the choice to hold steady when everyone else is panicking, the choice to trust the process. These are the choices that create the gap between a nice savings account and life-changing wealth. The good news is it's never too late. You can be Alex. You can start today. The choice is yours.